In a world where regulations grow more complex by the day, compliance alone is no longer enough. What organizations need today are RegTech solutions, powered by deep consulting expertise, to navigate complexity with confidence. Built on real-world consulting experience, Cygnus GRC Suite from the House of Crowe, one of the world's top 10 consulting firms, is a reliable RegTech solution that helps organizations navigate complexity with confidence. Cygnus Aura, transforming internal audits through intelligent automation. Cygnus Regulus, enabling regulatory audit readiness. Cygnus Nexus, proactive risk management for informed decision-making. Cygnus Vigilus, complete oversight through real-time transaction monitoring. Cygnus Scan, AML, and sanctions screening to prevent financial crime. Cygnus Vault, intelligent and secure regulatory document management. Cygnus Identia, smart KYC, and onboarding for seamless compliance. In today's regulatory landscape, compliance is not optional. With Cygnus GRC Suite, organizations stay compliant, resilient, and future-ready.
Are you still managing enterprise risks in scattered spreadsheets and siloed reports that no one reads? Today, risks change faster than ever, and leadership needs a single, reliable view of what really matters across the organization. Cygnus Nexus Enterprise Risk Management brings all your risks, controls, and action plans into one integrated platform, so you can move from reactive firefighting to proactive, data-driven decision-making. With Cygnus Nexus, you can gain a 360-degree view of your organization's risk landscape, align governance and compliance, adapt to shifting risk appetites, regulatory changes, and strategic priorities. An intelligent enterprise risk management ecosystem that transforms the way your organization identifies, monitors, and mitigates risk. Centralized risk intelligence. Gain a single source of truth for enterprise-wide risk management. Proactive risk monitoring. Stay ahead of threats with continuous monitoring and alerts. Control and compliance management. Ensure compliance and control effectiveness with built-in RCSA tools. Incident and loss governance. Respond and learn from every event. Security and audit readiness. Protect data integrity and ensure regulatory confidence. Intelligent dashboards and analytics. Empower decision-making with real-time data visualization. The result? Stronger governance, fewer surprises, and better alignment between risk, strategy, and performance. Your teams gain one source of truth, auditors get clear evidence and audit trails, and management gets forward-looking insight instead of backward-looking reports. If you want to modernize your risk management and make informed decisions with confidence, explore Cygnus Nexus Enterprise Risk Management with Crowe UAE and see how it can fit your organization. Book a demo. Cygnus Nexus. Smart risk management for proactive and informed decision-making.
A very warm welcome to each and every one of you. Thank you for taking the time to join us today. We are truly delighted and encouraged by the overwhelming response we have received for this webinar and the high number of registrations we have received. Let me just quickly share my screen. All right. So the number of registrations that we have received, the strong interest clearly reflects how important and timely this particular topic of effective management has become, especially with the growing regulatory expectations and enforcement by the Central Bank of UAE and other authorities. Before I invite our speaker today, I would like to give you a brief introduction of Crowe. Crowe Global is one of the world's top 10 accounting and advisory networks with over 42,000 professionals across 140 plus countries. Crowe Global delivers unparalleled global expertise and reach. Here in the UAE, Crowe's story began in 1981 when Dr. Khalid Maniar founded the firm as a dedicated chartered accountancy practice in Dubai. From those humble beginnings, we have grown into one of the leading professional services firms in the region with five offices across the country and a talented team of more than 500 professionals. Since Crowe's establishment in the UAE in 1981, we have accumulated over 4 decades of expertise in audit, consulting, and recently technology-driven solutions. Over the last 4 decades, we have supported a wide range of industries, including financial services, real estate and construction, insurance, automotive and transportation, metals and mining, media and entertainment, retail, oil and gas, government and public sectors, tourism, hospitality, and healthcare. In the financial services sector, we support banks, exchange houses, non-banking financial companies, and fintech companies with comprehensive financial audits. We also integrate advanced technology solutions to streamline compliance processes, optimize risk management frameworks, and effectively meet regulatory requirements in line with industry best practices. Today's webinar, Effective Risk Management in Licensed Financial Institutions. It is specifically designed to bridge the gap between having a risk management framework on paper and making it truly effective in practice. It is now my great pleasure to introduce our distinguished speaker for today's webinar, Mr. Piyush Das. Mr. Piyush Das brings with him an exceptional blend of hands-on banking leadership and deep academic expertise. With over 30 years of experience as a senior banker with State Bank of India across Mumbai, Singapore, and Kenya, he has held key leadership roles, including head of treasury, fund manager, and credit manager. He also served as head of treasury at SBI Singapore and chief dealer in SBI Central Dealing Room. Later, he transitioned into academia and training, serving as a senior lecturer for 9 years at the Emirates Institute of Banking and Financial Studies in Dubai. He currently serves as director, training and development at Crowe UAE Academy. A certified anti-money laundering specialist and an appointed ACAMS instructor, Mr. Das also holds the CAIIB and CISI certification in UAE financial regulations. Mr. Das, thank you for joining us today. The floor is yours, sir.
Thank you, Prajesh. Good morning, ladies and gentlemen, on the session. Warm welcome to all of you. It's a great pleasure to be doing this webinar on a very, very important area: effective risk management, enterprise risk management. And we'll talk all about this. However, before I start, I want to take you through a small quiz just to, warm you up. So let's begin with the quiz, and then I'll take you through the presentation. Here comes the quiz, ladies and gentlemen. All of you can easily join the quiz. There'll be just 3 questions. It won't take much time, but you will enjoy the session. So please scan the QR code, enter your name, and join the quiz. That's all. And there are just 3 questions. Excellent. As soon as we touch 100, we'll start the quiz. Yeah, we are 85 now, 84 now. Okay, 85 is good enough. Let's start the quiz. Here comes, ladies and gentlemen. What is risk as understood by licensed financial institutions? You have to choose one of them. Awesome. 96 out of 98 answered the quiz. And the correct answer obviously is it's the chance of a loss. And I'll explain why that is the right answer. And we have at the top of the leaderboard ARN, Ashik, Amit Anand Suvarna, Maddie, and Mark. Here's the next question. Which measure identifies risk in financial institutions? Risk as they understand it, right? Which measure is the one that identifies risk or measures risk in financial institutions? Awesome. 81. Oh, we touched 100. Okay. So the right answer is unexpected loss, and you will see why that is so. And so we have ARN, Ashik, Rochelle, MC, and Robin. And the last question, risks are subdivided into financial and non-financial risks. Which of the following are financial risks? You have to choose three of these. Three of them are financial risks. So which are the financial risks? Choose three. Ninety-eight out of 103. That's a top participation. Okay. Yes. The answers are credit risk, liquidity risk, and market risk. Operational risk is a non-financial risk. And so we have at the top, Robin, the winner. Mark, number 2. Lara, number 3. Rahul Bajpai, number 4. And Raheel Khan, number 5. Congrats. Give them a big hand, please. And so let's move on to our presentation proper. Here comes the presentation, ladies and gentlemen. Yes. So warm welcome to all of you. to this presentation, the webinar on effective risk management in financial institutions. And, the session agenda or the highlights will be what is risk management, understanding risk, how do we define risk, what are the major risk categories, why financial risk and non-financial risk are so called, and we'll see what are the global enterprise risk management frameworks and what is the risk management process. How do we identify risks? How do we assess risk? How do we manage the risk? And I call it treatment of risk because there's different approaches to managing the risk. And we look at monitoring risk, and one of the most important tools to manage risk is the KRI, key risk indicators. And we look at how important they are. We look at the other regulatory standards, technology platform for managing ERM. And then after I finish with this, I'll hand it over back to my colleague, Prajesh. So, ladies and gentlemen, what is enterprise risk? What is enterprise risk management? Now, very important, there are two approaches to managing risk. One is traditional risk management and enterprise risk management. Enterprise risk management is a structured approach, helps organizations to identify, assess, prioritize, and respond to risks proactively. That means we try to look at risk, we try to harness this risk. And obviously, we want to meet our most critical business objectives. Now, the problem with traditional risk management is it's a siloed approach. Every risk is treated separately, not so in ERM. We have a holistic approach. We crash through the silos to manage the risk in a holistic way, an enterprise view of risk exposure. You know why this is important? Because risk do not occur in isolation. When risks occur, there are more than one risk that actually occur. For example, I just want to give you an example because I've been in risks for so many years and I can understand how a siloed approach defeats risk. For example, look at credit risk. Credit risk is, when a customer takes a loan, does not repay the loan. And this could be risk linked heavily to operational risk. For example, you don't take proper documentation, which is an operational risk. Client does not pay because he knows he's protected. He need not. You can't file a case against him. When you appraise a loan improperly, that's an operational risk because you don't have the know-how, right? So please understand this, that risks happen together. Many of them combine together. So you have to take a holistic approach about risks. And it is strategic in nature. Enterprise risk management is strategic in nature in the sense it does prevent losses, but it is also, about opportunities. Risk is an opportunity. If there was no risk, you would never seize opportunities. And so you have to integrate risk into strategic planning. When you think of plans, but very important for you to understand, you link it, to the losses you have. And how that is done, we'll talk about it. So strategic planning, strategic decisions have to be, tailored with risks that you have. Of course, all regulators require CBUAE, DFSA, FSRA expect everyone to embed enterprise risk management into your operations. It is an inalienable part of your operations as per the regulators. So, ladies and gentlemen, let's understand risk. And you did a quiz. It is the chance of a loss. Risk results in a risk event, which results in a loss. So how do we really understand what is risk? Risk may happen, may not happen. So there's a probability, the likelihood of occurrence. Also, there's impact. So a combination of probability and impact is what is risk. So how is risk measured? Now, there are various measures of risks, and that is expected loss. Now, what is expected loss and how does it help us? Anyone would like to tell me what is expected loss? How does it help us? What is expected loss and how does it help us? Any idea what is expected loss and how it helps us? Anyone? You can just put down on the chat box. How does it help us? You know, these are terms. When you manage risk, you have to be aware of these terms. Average amount a company is willing to lose. And so we have from Nabila, Rahil, Nabila, Ureb, loss that I anticipate based on my operations. When I consider that I can plan better, level of default. Mustafa, thank you. Gitu, Jayan, help us identify risk threshold. Yes. Thank you, ladies and gentlemen. This is the average loss that you incur. But that is not risk, ladies and gentlemen. The expected loss is not the risk. That is not a measure. It's the average loss over a given period. Normal baseline. The risk is the unexpected loss. And I'll give you an example. Losses over the expected loss, and you measure it through standard deviation. And all of you must have worked on standard deviation, variance. These are measured of unexpected loss. So risk is expected loss plus or minus standard deviation, right? And I'll give you an example. Say a company had fraud losses, 2%, 3%, 8%, and 2.5% over 4 years. The expected loss is the average loss. That's 3.875%. That's expected loss. So why do you use it? This is actually used for provisioning. You make provision because that's not risk. So you provision it. From your profit and loss, you keep it aside, your expected loss. So how do I predict what will be my loss? Expected loss plus or minus standard deviation. And standard deviation in this case is 2.8. So risk. What is your risk? That I could lose between 1.08% to 6.6. How did I get it? Expected loss plus or minus one standard deviation. And what is the probability? 66%. 66%. No, I want a better estimate of risk. You say, okay, expected loss plus or minus 2 standard deviations. That is 95% accurate. No, I want a better estimate of risk. Expected loss plus or minus 3 standard deviations. That is almost 99%. So as I said, expected loss, provision. What about unexpected loss? Unexpected loss is mitigated by capital. That's one of the things. So you must have all financial institutions arranged to have capital equal to 3 standard deviation, expected loss plus or minus 3 standard deviation. That is the capital requirement. So risk is mitigated to a large extent by capital. So and that is also linked to your capital. Capital. That means that is your risk capital. No, I can't lose 3 standard deviations. Therefore, I'd rather not take on this amount of risk. So it is intimately linked to your capital. Your business model will be linked to your capital, the amount of losses you're able to take. And how it is linked to probability is what I told you. Okay, so why risk management programs fail? Because there's no leadership commitment, right? It's a compliance checkbook, because ultimately it is about risk appetite. It is about, having a corporate culture, and that is only possible through leadership commitment. Siloed, fragmented approach. Every department is separate. Fraud, money laundering, anti-bribery. They're all separate departments. They don't work together. Technology prefer. Many people think if I have a platform, I don't need to, really work on anything else. No, it is an enterprise-wide effort. And there's a lot that goes into the data, the information that gets into your technology platform. Static frameworks. You have to continually evaluate your risk. It's not a one-time exercise, right? So you have to keep on evaluating, updating your controls, identifying new risks, the quantum of risk, risk can change. So it has to be a dynamic framework for data quality. Today, data is coming from all sources. In fact, I'll talk to you about a particular framework. Today, that framework has been modified in 2024, the COSO framework, ERM. And they say you have to get even from social media, data to update your data quality, right? So you have to update your data quality, the kind of quality data that you need, and that will give you better understanding about your risk. And it's not about compliance. It is about understanding risk. It is about practical application of risk. It's not a tick box approach. So this is why risk management ensure that you don't stick to these areas. Now, as I said, we look at the major risk categories, and there are 2 major kinds of risks: financial and non-financial. Now, I want to ask you, what's the difference? Why are risks classified as major or minor? Okay, Syed Arsalan Hussain. Syed Arsalan, I thought I answered some of them. Okay, but if you're not satisfied, we'll take it up at the end. Right, Mr. Arsalan? Is that okay? Okay. Please give me a while and I'll come back to you. I'll try to answer your question. Okay. Now, what is the difference between financial and non-financial risk? Why are they differentiated? Because, you know, the impact of both could be financial losses. So and you answered a quiz question. You saw credit, liquidity, market risk are non-financial, are financial risks, whereas operational risk is a non-financial risk. But the impact will be financial. So why are they differentiated into finance? Would anyone like to answer this question? Why are they differentiated as financial and non-financial risks? Would anyone like to answer this? Yes. Mohammed, what a wonderful answer. Mohammed Akhlaq Hussain says financial risks affect money and financial performance directly, whereas non-financial risks arise from business operations, from people, systems, or external events. I think, you know, although the answer may not be very clear to others, I know that you know the answer. Mohammed Akhlaq. Anyone else would like to answer? Perfect. Yeah. My question, Mustafa, is why are financial risks called financial risks and non-financial risks as non-financial risks? Although both are impacted financially. A company can be impacted financially, both by financial and non-financial risks. So what is the risk? What is the reason? You're right. Both will impact reputationally as well as financially. Liquidity is a financial risk. Okay, so thank you for attempting to answer this question. Let me answer you. Financial risks can be managed through financial instruments like credit, you know, buying investments. So you can manage financial risk using financial instrument. That's one. The second thing about financial risks is that you can originate risk. That means you can increase the level of risk or reduce the level of risks. For example, you would like to, you know, take on more profitability. And so you take on, you know, triple C rated clients, lower credit risk categories. So you can change your, you know, risk levels using financial instrument, right? You can take on, you know, those who don't want to take risk will lend to only AAA rated, you know, companies. Whereas someone who wants to take on more risk appetite, they will go to triple C, triple B rated loans, right? So you can originate risks, financial risks, but non-financial risks are an outcome of the financial risk that you take on. They are an outcome, right? So you have to manage them, right? You are an outcome of, you know, nobody says, I want to make profits, so I will increase my operational risk. That's not how you speak, right? So operational risk and other risks are an outcome of the financial risk that you take on. And financial risk can be managed through financial instrument, whereas non-financial risk cannot be managed through financial instrument. That's the big difference. Is that okay, please? Have you got it? Thank you. Yes. Okay. So financial risks, a credit risk, and there's no one single credit risk. You have default risk, migration risk, when, you know, the credit rating of a borrower changes from, say, AAA to triple B, right? Or AA. That's migration risk. That is also kind of a counterparty risk, settlement risk. One of them is head stat risk, sovereign risk, country risk. Sovereign risk is when the government is not able to repay its bonds. Country risk is what you evaluate basis of pestle analysis. Market risk, losses from price fluctuations, commodities, foreign exchange, equity shares, and this is generally the Treasury Department, the one that does trading activities. Liquidity risk, inability to raise cash, inability to meet liabilities. And there are two: funding liquidity risk, that I don't have the money. Market, and I'm not able to, sell my investments, right? So those are funding liquidity, market. Liquidity risk is, and so the big difference between liquidity risk and credit risk. When others are not able to pay me, that's my credit risk. When I am not able to pay, that is my liquidity risk. Interest rate risk is basically, there are two kinds. One, interest rate risk is directly linked to market risk. Yield curve shifts, basis risk, optionality, right? Optionality is so interest rate risk is market risk, and there is also a banking book risk. Banking book risk. And what is this banking book risk? Interest rate risk is market risk, and that is when you purchase bonds and movement of the yield curve. There's also another interest rate risk when, banks match deposits to loans. So if they have given loans on the basis of a current base rate and deposit rates change, they go higher, then you are not able to refinance at the old rate. So that's a banking book risk. So interest rate risk includes both market risk and the banking book risk. Okay, so non-financial risks are operational risks, employee errors, process errors, and please remember, all of you today, money laundering and terrorist financing have become much bigger than operation, but it is a part of operational risk as per Basel Committee. So MLTF is a part. So, but today MLTF has become so big, it's the tail that wags the dog, right? So process failures, system failures, cyber risk, internal and external fraud, and business continuity management out of the external events. So that's operational risk. And then strategic risk, your company could make poor strategic choice, like enter into new markets, product launches, business model shifts, and this could lead to financial losses. Compliance risk is, compliance risk here is not money laundering and terrorist financing risk. It is not failing to comply with laws, regulation, and industry standards. Reputational risk, loss of brand image, and customer, employee, media, or public backlash from scandals, poor services, mishandled incidents, mishandled crisis management, So this is reputational risk. Environmental risk today has taken a center stage. All companies are required to, subject to two risks. One, climate risk itself, and then climate risk. And climate risk, are two types. Actually, three types. One is adaptability risk, transition risk, and the normal risks. That is, you face from extreme weather events, and transition risk is the world is transitioning to a new kind of environment. So if you're not able to adapt, then you have adaptability risk. That's transition risk. And third climate risk is liability risk, that because you're releasing emissions into the atmosphere, it may result in liability, suits, etc. And business risk is about unpredictable consumer trends, innovations, political and economic upheavals in the environment. So customers are not coming to you. You've lost your customer base. Now, business risk is in the current situation, strategic risk in the future. They are similar in nature, but that's the difference. And I want to make environmental risk, it also includes ESG risks. ESG is environmental, that is your emission levels, and there's scope 1, scope 2, scope 3 emissions, your customers, your emissions is scope 1, emissions of your energy providers, that's scope 2, and your supply chain, their emissions is scope 3. You'll have to look at all of those. Now, what are the major ERM frameworks? And these are international standards that can be, taken on by, regulated, licensed financial institution. And the first, of course, for banks, it is Basel III pillars. But you can also, tune your risk framework on the basis of Basel. Pillar 1, minimum capital for credit, market, and operational risk. And roughly they say, risk is measured through risk-weighted assets. And you have to have 8%, that's the general global standard, of your risk-weighted assets as capital. Because, Basel framework links capital with risk. But you have to have add-on capital, because banks have other risks besides credit, market, and operational risks. So there's an add-on Pillar 2 capital. Also, there is other, Pillar 1 capital, additional capital, which you decide on the basis of internal capital adequacy assessment, stress testing, supervisory review, all that decides how much additional capital you need for the Pillar 1 risk and also for the Pillar 2 risks like strategic risk, business risk, ESG risk. You need more capital, right? And you have to disclose in your balance sheet, right? You have to make public disclosures about your Pillar 3 risks, your risks. Also, COSO ERM. COSO is Committee of the Sponsoring Organizations of the USA, includes Institute of Internal Audit and others, right? So that's an enterprise risk framework. And it has 5 components: governance and culture, strategy, performance, review and revision, information and communication. Now, performance is a very important part, and that includes risk management process, and I'll talk about it. ISO 3000, 31000, 2018 has principles, framework, and process, and it is applicable across all sectors. And this process is the risk management process, which is common. Performance in COSO ERM, process in ISO is the same. Then you have the Institute of Risk Management. It is also IRMIC for insurance companies. COSO, internal control framework, is also and I've been using it since, when I joined the training faculty in 2011. This is an internal control framework, how you set up internal control. And the most important is the control framework, the tone at the top. Risk assessment, right? How you evaluate risks. Control activities, how you mitigate and treat the risks. Information and communication, how information is processed, and monitoring the risk. This is the KRIs. And, COSO underpins SOX compliance, and you must know about SOX. In fact, all companies, financial institutions must implement SOX in some form of the other. Now, what is SOX? SOX is Sarbanes-Oxley Act. In the US, this act came into being after the Enron scandals, where they repeatedly abused the financial reporting system, did not report their risks. The Enron company, it was one of the largest energy firms. So all companies in the US had to have SOX compliance. And SOX is simply internal controls over financial reporting. You have to have controls. So even in the UAE, a lot of firms implement internal controls over financial reporting. And that's where they use COSO internal controls framework. Okay, so ERM framework, 3 very important frameworks. 1, risk governance. There should be a board level risk committee. There should be an independent chief risk officer. 3 lines of defense. Now, I want to ask you, because that's a very, very important concept which people don't follow. Can anyone tell me what is the 3 levels, 3 lines of defense? What does it mean? What are the 3 lines of defense? And why is it an important control? All of you know what is the 3 lines of defense. Why is it an important control? Okay, Mark Poussard says frontline users, compliance and risk, internal audit. Yes. So Mark is correct. Frontline users, frontline staff are the first line of defense. Second line are risk, compliance, finance, right, are the second line. And internal audit are the third line. Mark is right. But why is it such an important control? Yes, Muhammad Akhlaq has the right answer, but let me see. Mustafa Hussain, first line is implementation, third line assurance. Okay. Yes. Very good. Jiwan Sa, second eye and third eye checks. Okay. So, ladies and gentlemen, what you have answered correctly, all of you. First line is to implement the controls. Identify risk, implement controls. Second line, to keep a watch over the first line. They are required to do it. Second line keeps a watch over the first line, that the controls are appropriately being implemented. Third line gives an assurance that the second line and the first line are doing the work. But the important control, which you must remember, first line is not allowed to do second line work. Second line is not allowed to do the third line work. And the third line is not allowed to do first line or second line work. And the second line, and that is independence of compliance and the second line, they are not allowed to do first line work. They cannot get into business development. So this is the control. Yes. Thank you, Muhammad Akhlaq. That is the right answer. That's why it is such an important control. Thank you. And risk appetite statement, which is a very important, requirement. Then strategy and risk alignment is about linking risk appetite with business strategy. And I told you, risk appetite is about how much you are likely to lose. And it is about capital allocation. You may not mention it because losses come out of capital. And you have to do top-down risk identification, which is absolutely correct. And financial firms have to do, after you calculate the capital, the senior management have to see that rules are only rules, but you have to be practical. Is our capital sufficient for our operations? Our operations are unique. No copy pasting. You have to evaluate it yourself. And now, can you tell me why scenario analysis is very important? Why is scenario analysis very important? Why is scenario analysis a very important part of risk management? Why? Anyone? Wonderful. We have some terrific answers from Muhammad Akhlaq and Arsalan. What if scenarios? I just want to give you a very important example. Risk happens when 2 or 3 risks occur together. What if scenarios are basically, and you're right about what if, when 2 or 3 risks, merge together and attack. The consequences can be more terrible than you can even imagine. And this is what the board needs to do. The risk management, etc., may not really envisage 2 or 3 risks combining together, attacking the company. And you must understand, when risks occur together, it is not the measure. The impact could be much more than you can ever imagine. That's why you need to do a scenario analysis. Very good. And of course, stress testing is what must be done. And the risk management process, is part of all frameworks. Identify, evaluate, treat, and monitor risks. Identify what are the risks I face? What are the areas that I face this risk? Evaluate how much risk do I have? Is it in relation to my risk appetite? How does it look? Treatment of risk. How do I manage the risk? And I'll tell you how to manage the risk. And one of the ways is how to identify risk. It's a very important part. How do you engage the whole organization? Risk control self-assessment, right? Risk heat, maps, KRI dashboard, annual review. This is the risk management process. So ladies and gentlemen, let's move into the risk management process. Risk identification techniques. Brainstorming, stakeholder review, risk control self-assessment, historical loss analysis, scenario analysis, process flow charting and SWOT analysis, strength, weaknesses and opportunities and threats. This is how you identify risk. However, please remember, it's not a tabletop exercise. You must get the whole organization to participate in this process. Practical risk register. Give a risk and identification number. Calculate the likelihood and impact. Give the risk a category, so that you have different higher level risk, lower level risk and things like that, risk category. Then give it a risk score. Likelihood and impact, maybe high risk, medium risk, low risk, and there could be other categories. Describe the risks and what is the risk appetite? The risk appetite, target state, and what controls do you risk respond? What controls that you're going to, how are you going to manage the risk? Use the TARA approach. And what are the current controls that you have in place? Are the risk effective? And that is how you calculate the effectiveness, give the effectiveness score, and then calculate inherent risk minus control effectiveness is your residual risk. Inherent risk minus control effectiveness is your residual risk. And somebody must be the risk owner because, okay, one thing is missing here is you also have to, in the risk register, you have to put your key risk indicator. And the risk owner will be looking at the key risk indicator. I'll talk about the risk indicator. Okay, how do you assess risk? You use a heat map. Remember, risk is about impact into probability or likelihood. And all of them could be put into, how do I get it? Say if the risk impact is 3, the likelihood is 3, then that's medium. Then you have 3 into 3, 9. That is how you get the matrix, 5 into 5 matrix. You divided all impact into 1 to 5, likelihood into 1 to 5, and then you decide each risk. What is the likelihood? What is the impact? And then you calculate the risk severity. 1 to 5, low risk, 6 to 5, medium risk, 13 to 20, treat the risk, 21 to critical, escalate, maybe avoid. So, when you do risk assessment, you must do qualitative and quantitative risk assessment. Qualitative also is very important. Describe the risk as low, medium, high, critical, or other categories like low, medium, high, medium low, high risk, right? You can do any of these categorizations. Expert judgment, historical experience, scenario analysis can come into this when you do the qualitative analysis. This is quick, intuitive. You get the inputs from the stakeholders. Limitations, there is a bias, a subjectivity that is involved. Scoring could be inconsistent, right? And initial risk identification for emerging risk. Quantitative approach, numerical probability into, impact, value at risk. Value at risk is the, the probability that your risk will not exceed a certain number. What is that number, right? So input, historical loss data, probability distribution, statistical models. Why this is very important, strong, objective, you can track it and you can allocate capital, right? And you can optimize your risks. Limitations, you need good quality data, best for credit, market, operational risk, and capital. And, controls are always about preventive controls, detective controls, and corrective controls. Preventive, prevent the risk from happening. But all risk cannot be controlled that way. You need to have detective control. And this is through key risk indicators, right? Reconciliations, variance analysis, surveillance, right? And corrective controls after you've identified that there is some, the controls are not working, then you have to set up corrective controls. Now, the most important, how do you manage risk? The Tara approach. Do you know what is the Tara approach? Have you heard it? Any of you? Have you heard the Tara approach? What is Tara approach? Okay. The Tara approach is transfer, avoid, reduce, and accept. That is the Tara approach. Transfer, avoid, reduce, and accept. Yes. So, gentlemen, transfer when you have low likelihood, high impact, like an earthquake. You may buy earthquake insurance or flood insurance, right? And insurance, hedging, contractual risk transfer, this is all attempt. It doesn't mean that you will not have controls, like you will have fire equipment, you will have a fire alarm bell, but you will also transfer the risk. Avoid high likelihood, high impact. You would not deal with a criminal because high likelihood, high impact. Exit the activity. Exit from the customer. Reduce high likelihood but low impact. Your credit risk. Likelihood, chance that it might fail, but impact because you ensure that the loans you give are not a large loan, right? You keep it within limits. So mitigate. This is the preventive and detective controls. Accept. Some losses, for example, minor losses, operational losses, employee errors, many of them would be very, very little. And the cost of managing these losses would be very high. So you accept certain losses, right? Like weather losses or something like that, which is not of great rains, etc. So accept losses, which is low likelihood and low impact. This is the Tara framework, must be used with great impact. So, ladies and gentlemen, monitoring risk. 1. Continuous assessment of your risk. Observe system, market operation to spot changes. Data tracking. Analyze log data, audit data, field visits, right? Data tracking. Adaptation and reporting. Update systems based on findings. And the most important, key risk indicators. For every risk, have a key risk indicator. For example, one of the risks of staff in operational risk is staff exits. What percentage of staff is exiting? Another key risk indicator, how many audit issues are pending? That's a key risk indicator. Credit risk. How is the economy doing? Right? Key risk indicator for credit risk is what is the GDP growth of the company. If the GDP growth is not good enough, your borrowers might not repay the loans. Simple. That's a key risk indicator. So you can have such key risk indicators. This gives you early warning metrics, right? So every material risk you have to have. For example, one area of money laundering and terrorist financing, how many of your peers have been fined by the CBOE? Shows that, the chance of you, doing better on compliance becomes very important, right? So compliance is becoming a big issue. So you'll have to look at all these key risk indicators. KRI monitoring should be done at all levels. Line 1, line 2, line 3. This is the 3 lines of defense. However, I just want to tell you, it's a powerful tool. And how is it a powerful tool? For example, and this is where risk tolerance come in. For example, say I'll just take 1, staff exits. 2% staff exits, tolerable. But if it goes to 5%, 2 to 5%, maybe HR must take notice of that. If it goes above 5%, that is when the senior management and the board of directors must get what is wrong in the organization. So this is how, escalation levels of KRI become very important. Risk reporting, executive dashboard, the board and the C-suite, what are the top 10 enterprise risks and trend? Is it increasing or decreasing? Heat map by risk category, risk appetite versus current exposure, the board needs to know. Management, senior management must look at the department level risk, the KRI status, control testing results by the internal audit, by the risk department, right? What actions have been taken, right? What is the monthly trend analysis, operational dashboard, real-time KRIs, control exceptions, incident alerts, system status, how is it being remediated, daily and weekly refresher of the KRIs, regulatory and compliance dashboard, AML CFT alerts, STR status, how many STRs have been filed, how many transaction monitoring alerts are pending, the aging of alerts, audit and compliance findings, compliance calendar, whether the the compliance officer has found the half-yearly reports or the quarterly reports, any data privacy or breach reports are all part of KRI, are all part of the dashboard. Now, just want to talk about the 3 pillars. Pillar 1 is the minimum capital for credit risk, market risk, operational risk. And the quality of the capital. Capital adequacy is the quality of capital. How much pure equity, how much subordinate. Capital also includes a tier 2 capital, that's subordinated bonds. They can also be capital. So the quality of the capital. Supervisory review process is ICAP, ILAP, internal liquidity assessment, stress testing, reverse stress testing, right? And supervisory review process. Market discipline is about reporting, public disclosure, risk measures and measurement methods. And of course, this is meant for investors, right? And every year you have to make this Pillar 3 disclosures. This is the Basel 3 pillars approach. What are the regulatory frameworks? 1, UAE, you have the CBOE circulars, DFSA Module 7 on cybersecurity, FSRA, FinTech, innovation, Kuwait, you have prudential controls, KSA, you have prudential standards, Bahrain, Basel III implementation, Qatar, you have the prudential standards rulebook, Oman, you have the prudential standards framework. Okay, you can have, a risk appetite worked as follows. Strategic risk, moderate. Operational risk, low. You want to minimize disruptions. You don't want staff exits to be small, right? Compliance risk, you don't want to mess with regulators. So very low. Financial risk could be moderate, high, because this is where you make your profits, ladies and gentlemen. Reputational, everyone wants low reputational risk. Cyber risk is always low or moderate, right? So this will be your risk appetite statement. Ladies and gentlemen, we will have a presentation on the technology platform, but I'll just briefly touch. What does the technology platform contain? Our CSA module, the KRI dashboard, which is very important, incident and loss data, the stress testing engine, right? See how, visualize scenarios, how your capital would measure when looked at stress scenarios. Risk register, all risks are recorded, and, the quantum of risk, the effectiveness of controls, what are the risk indicators are all put in the risk register. And obviously, also you have to have the risk levels, regulatory reporting, right? You have to report on your risk. So CBUAE, DFSA, FSRA, you have to give reports to the regulators and to your board. Risk culture and organization, tone at the top, risk awareness training, a speak up culture. You have to cultivate the risk culture. And unless you encourage people to speak up, all risks may not be identified. Accountability. People must be accountable for the decisions they take. Incident transparency, because unless you're transparent about incidents, you will not be able to get into the root cause and you lose a big element of risk discovery. And the board must be continually engaged, because today, corporate liability, there's a CBUAE rule book, a CBUAE law that has come out. That is law number 6 of 2025. And that says companies can be fined, financial institutions can be fined up to 1 billion if there is a violation, misuse, and so the fines can be huge. The regulator can impose fines up to 1 billion dirhams. So risk management maturity model. One is an ad hoc model, reactive. When there's a problem, you try to identify, define, you have a policy, annual risk assessment, you have KRIs, you have a risk committee, you have training, integrated platform, establish monthly KRIs, quarterly RCSA, risk-linked compensations. Very important that you understand this. Risk appetite statement is well documented. Mid-sized banks can do this. Manage real-time dashboards, predictive analytics, advanced scenario modeling, good risk culture. This is for global financial institutions. And finally, optimize AI-driven intelligence, autonomous control testing, forward-looking indicators, leading indicators is what I mean, as opposed to lagging indicators. KRIs can be both lagging and leading indicators. You must have a combination of both. And industry leaders use the optimized approach. So, ladies and gentlemen, common pitfalls. Risk register is shelfware, right? It lies on the shelf. Too much reliance on spreadsheets. Siloed risk management, controls designed for audit, not real risk. So you want to answer to audit. You want to answer to the regulators, but you don't care about the real risks. It's a tick box approach. Regulatory risk treated as isolated compliance. So how do you avoid this? Clear ownership, quarterly reviews, and link unresolved risks to board escalation. Implement integrated GRC platform, automate KRI feeds, ensure audit trail, version control, and cross-functional steering. That means include everyone from various departments. Integrate risk into the decision forums, consolidate reporting, test for real-world effectiveness. That's the key, effectiveness. Adjust controls to exception data, right? You must keep evaluating these controls, ladies and gentlemen, keep evaluating. And embed regulatory intelligence into risk assessment. Stress test for new requirements. Engage regulators proactively. This is very important because regulators give you feedback, must put it into your risk assessment, stress testing based on what you hear from your peers, right? And you have a better enterprise risk management. Ladies and gentlemen, key takeaways. ERM is a board level responsibility. Regulators expect documented risk appetite, governance reporting, risk measurement. Please take care of expected loss, unexpected loss, standard deviation, right? And Always try to link your objectives to your risk appetite and to your capital requirement. Use a heat map to prioritize risk, to manage risk, and to strategize risk as the approach. TARA is the go-to treatment. Every risk must be transferred, avoided, reduced, or accepted. Some of the risks can be transferred, can be reduced also. Like I told you about fire. You buy insurance, but you also mitigate the risks. KRIs are one of the most important tools in enterprise risk management because many of them are leading indicators, ladies and gentlemen. Please make them as a part of your risk management. Technology is an enabler. A dedicated ERM platform ensures audit readiness, regulator submissions, real-time oversight. Ladies and gentlemen, I'm done. Can I invite Prajesh? And after Prajesh, and then there will be a presentation from Ashwin, and then we will have the question and answer session. Thank you, Prajesh. You can take over.
Thank you so much, Mr. Prajesh Das. We are truly grateful for your outstanding session. You delivered exceptional value by clearly explaining the risk categories, the three pillars of the ERM framework, effective risk identification techniques, practical ways of building a meaningful risk register, and the highly useful TARA framework for risk response. Your insights on measuring risks and translating theory into actionable practice were particularly valuable for all of us. Thank you once again for sharing your vast experience and deep expertise so generously. On behalf of all our participants, we extend our sincere gratitude for your wonderful presentation. Um, before before we proceed, I'd like to show you some of the applications which are used to translate today's learnings into action. Let me just share my screen. So I'd like to introduce the Cygnus GRC suite, a comprehensive intelligent platform designed to help licensed financial institutions move seamlessly from framework to action, just like how Piyush sir had explained. Together, these solutions work as one unified ecosystem, which enables you and your organization to move from, say, a fragmented process to a single regulatory-ready GRC environment. If you see right at the top, we have Cygnus Atlas. This is our data center, ensuring all the applications that we develop are hosted in UAE itself as per the CB UAE regulation on data residency. We have Cygnus One, which manages automated integration between various applications that's being developed by us from a single centralized dashboard. Cygnus Nova is our advanced AI core designed specifically to inject adaptive intelligence across the entire GRC suite. And Cygnus Scan is our intelligent AML and sanction screening application that helps organizations detect and prevent financial crimes. At the core of this suite, I mean, these are the different applications, but today, relating to our discussion we had, at the core, we have Cygnus Nexus, our flagship solution specifically built for enterprise risk management, perfectly aligned with the themes that has been discussed today. It is now my pleasure to invite Mr. Ashwin Nair, our subject matter expert, who will walk us through a live demonstration of this application, Cygnus Nexus, and showcase how it can strengthen your risk management practices. Ashwin, the floor is yours. Thank you.
Hi, Good morning, everyone. So, Mr. Prajesh, thank you, and Mr. Prajesh, really a wonderful presentation. I will now present the Cygnus ERM system to you, which is named as Cygnus Nexus. I hope my screen is visible to all of you. Okay. So
Yes.
this is the Cygnus Nexus system, which is used for the ERM function. This system has been prepared in line with the UAE regulations, the COSO framework, and the ISO 31000 standards. So this particular ERM system is used for the risk management process, which starts with risk identification, risk analysis, risk mitigation, and risk monitoring purposes. For the risk identification purpose, we have the RCSA module, wherein you will be able to circulate the RCSA, that is the risk and control self-assessment questionnaire, to various stakeholders of your organizations, wherein the respective stakeholders will be required to input the various risks and controls existing in the respective departments and provide you with the results. Another module for risk identification is the incident log, wherein you or the respective stakeholders will be required to input the incidents that has occurred or the near miss incidents that would have happened in your organization. Once the incident has been recorded via the incident log, the risk manager or the risk department specialist will be assessing the same and incorporating the results of the same within the risk module. Once the risk has been identified, it will be recorded into the risk register, which is shown over here. Within the risk register itself, you will be given the option to record the impact and likelihood ratings. So there is based on the impact and likelihood rating, the inherent risk will be calculated based on the defined methodology in the system. Once the inherent risk has been identified, next move to the control assessment area. Within the control assessment area, for each of the risks that you have identified, you will be given an option to assign the respective controls. So for this particular risk item, you can see credit appraisal framework. This is the respective control. Once the control has been assigned, you will also be given the option to assign the design rating and the performance rating for the respective controls. Based on the design and performance rating, the overall effectiveness of the respective control will be calculated. And once the control effectiveness is calculated, the system, based on the defined formula, will calculate the residual risk of the organization for you, as you can see here. Okay. So the inherent risk has been calculated, and the control has been designed, and the effectiveness of the control have been rated over here. Based on the formula, the residual risk is also calculated and assessed over here. Okay. Once the residual risk has been calculated, next comes the risk monitoring purpose. For that purpose, we have the KRI module. Within the KRI module, you are given the option to add multiple KRIs and link the respective KRIs to the respective risk items. A single KRI may be linked to one or more risk items. And within the KRI, you are given the option to add various threshold configurations. And upon reach of the respective thresholds, the system will be generating and giving you an alert. So using this particular module, you will be able to assess and identify the inherent risk, the residual risk, and the control rating or the control performance of your organization, which you can use for the overall ERM function. This particular report will also give you, this particular system will also generate the report which you will be able to submit to this to your senior management and to the regulators as and when it is required. All right. Mr. Prajesh, that's it with the ERM system.
Thank you so much. Thank you so much, Ashwin.
Thank you all.
That was an excellent and detailed demonstration. We truly appreciate you walking us through Cygnus Nexus, Ashwin, so clearly and showcasing how it brings the risk management frameworks to life. To all our participants, if you would like to explore Cygnus Nexus further or see a personalized one-on-one demonstration, what you saw right now is just some of the key aspects of the application in the presentation. So if you want a tailored one-on-one session, you can contact us. We will be sending you this recording as well as the presentation, so you can respond to us, and we will get in touch with you. And we would be happy to arrange a dedicated session for whoever is interested. We will now open the floor for any question answer session, and Piju sir and Ashwin will be here to answer your questions. Who wants to go first? You can either leave your questions on the chat. Let me just open the chat. I think all the questions which were there earlier, Piju sir has addressed all those questions. But if you have any further, you can leave them. We will be live for another few minutes. If there are no more questions, we will end the session and we will get in touch with you.
Yes, you can also keep asking the questions.
Yes, Piju sir. We have a question here by Nigel.
Yeah.
Bessie. Yeah.
How do you go from a 5-to-5 matrix to an actual dollar amount? Very good question. This this matrix, for example, likelihood. What is likelihood? How many times in a year, right? So that actually measures likelihood. For example, if it's 1, what is the likelihood? That means may happen, never happen. 2, maybe once in 5 years, things like that. What about impact? Every risk level has an impact attached to it. So, for example, 1 or 2 maybe losses of 10,000, 50,000. There are ways that you do this. So impact levels are the ones that is, linked to the losses which you define. And based on historical losses, you allocate the number or historical levels or expected losses to each risk. So the impact levels will be linked to the matrix 1 to 5. I hope I've answered your question. And how can you use this for ICAP Pillar 2? This is to be done at the senior management at the board level. Do I have enough capital? Now, this is slightly different in the sense you will check. This is about the anticipated losses, where the board feels that the amount of capital that we have laid out or the risk levels we have thought about is likely to be more. For example, this is what exactly the 5-to-5 matrix that you have, put down on paper when you develop the heat map. The board says, no, I beg to differ. And so the board feels things have changed since the last review. Therefore, we need to increase capital. So that is where ICAP comes in. Is that okay, please, Nigel? Any other question, please?
So I think I will answer that question.
Yes, please do.
To Rahil. Rahil, Sickness Nexus system is completely integratable with all the other systems which you will be using within your organizations. And based on how the level of integration that is possible in your organization, we will be able to pull out real-time data from your other systems and generate the KRI alerts to you on a real-time basis. Once the integration is possible, or if the integration is possible, the alerts can be automated and generated on a real-time basis. Otherwise, it will be dependent on manual entry. So that will be on an integration level scope.
Okay, Salma Khan's, that's a very good question. Does your risk assessment framework differ across jurisdictions, UK, Canada, where regulatory, of course, it will be linked to the regulatory expectations and the regulations. There's no doubt about it, but I'll ask my friend Ashwin to answer that.
Yes,
Ashwin?
yes, to Salma Khan, yes, we have ensured that the system is, equipped with the globally accepted standards, which are the COSO framework and the ISO 31 standards. So this is also accepted throughout UK and Canada as well. And the regulatory expectation, if you look at the regulatory expectation within those countries, it is also aligned with these standards. So yes, it is. Also, just an add-on to this, the system, if you require any modification in the methodology, is completely configurable. That is, if you want to change the scales or the methodology behind the calculation, that can also be deployed within the system. Yes, it is, Salma Khan.
We have a question from Amit Anand.
Yes, Mr. Amit Anand. Yes, Mr. Amit, we have a workflow risk-like cycle, which is
The
being managed
question
in
is for
Cygnus.
Ashwin.
Yes. You may contact us directly for this. We will give you a detailed demo on how this is working within the Sigma system. Okay.
Ashwin, I can't hear you.
Am I not audible?
Yes.
Yeah.
Ashwin, yes.
Yes. So, Mr. Amit, as I was telling, yes, this particular function is available within the system. You may contact us directly, and we will give you a detailed demo on how this is working within the system. Okay.
Is that okay, Amit? Hi, Amit.
Hi,
Is this clear?
Piyush sir, I didn't hear anything what Ashwin said.
Okay. I just want to tell you what Ashwin said. He said, yes, we have a workflow available, right? And you can see the risk life cycle, how it is managed in Cygnus. And if you want, we can give you a demo.
Sounds
You
good.
can
Thank you.
contact us directly. Yes, satisfied, Ashwin.
Yes, sir.
All right. Any more questions?
You can always keep coming back to us. It'll be a great pleasure for you to interact. You know, from the organizers, you can take our contacts, talk to us through our organizers, and then we'll be more than happy to answer all your questions, ladies and gentlemen. Thank you. Thank you for being there, attending this webinar. It's a great pleasure to be talking to all of you, ladies and gentlemen. Prajesh, please go ahead.
All right. Thank
you
you
all.
once again, Pijuda sir, and for the insightful session, and Mr. Ashwin for the wonderful presentation. A big thank you to each and every one of you for attending today's webinar and for your active participation. You asked some fantastic questions. We will be in touch with you. So if you're interested, you can always ask for a one-on-one session. Have a wonderful day. Thank you so much.